Hi everyone.
Today's webinar, RMA Valuation Edition, Enhancing Your Financial Statement Benchmarking. My name is Dave Miles. I am the moderator today as well as the presenter. So before we get too far into this, I want to do a little bit of housekeeping. First is, there's a disclaimer on the slide deck. Make sure you vet everything I say. Make sure you take what I say as a guidance and say I can go out and discover these things for myself, and you go out and do that. Everything I say today you should be able to verify on your own, and so I just try to say it's a lie. Make sure that you vet it for your own self. So let's go ahead and get into what we're going to take a look at today. We're going to look at what problem does the RMA data solve. We're going to look at a little bit of history on the annual statement studies. Where does it come from? Why does it exist? We're going to look at the Valuation Edition. The Valuation Edition is exclusive to ValueSource. Nobody else in the world has it. We have some resellers out there, and NACVA is one of our resellers, and they will allow the Valuation Edition to be put into place, but it's exclusive to ValueSource. And we will talk about what's special about it and why you might be able to use it and how it might add credibility to your particular reports. We'll talk about how that process is used inside of the valuation framework. Let's take a look at why we need the RMA data. So one of the databases that we have at ValueSource is the IBA market data, and I have the ability to go out there and look at the entire data set, and when I sort the price to seller's discretionary earnings ratios, and I take the middle 50%, so right around the median, right around the average, right around the harmonic mean, take 50% around that number. So I'm cutting off the two outliers. Here's the lowest outliers and the highest outliers. There's a 300% point swing between the low and high values on that. Some of it's 2 times earnings, some of it's 6 times earnings. And that 300% swing creates a problem for us as valuation professionals. What number does our particular company derive, or what does it desire? What's a substitute for it? What's a substantial equivalent for that particular thing? Is it one of the lower numbers, or is it one of the higher numbers? And obviously this is all over the board. When you take the entire data set, you're talking different industries, different business models and things like that. But the idea is that how do you tell whether you are strong or weak in the marketplace? Also, everybody knows that the standards require it. In fact, in most engagements for a CPA, you have to do a ratio analysis on the financial statements, and usually you have to apply it against a peer group and say, where do you stand in the peer group to see if it's good or bad. And what we're really trying to say is let me give some empirical evidence for those strengths and weaknesses. Well, as I said, I used to audit financial institutions, and the very first thing we did was here, let's run out the trial balance, and now let's do our ratio analysis. And in our management letters, here's our management improvement letter. One of the very first paragraphs was, here's your ratio analysis. Your capital was too strong or too high, or it was too low or too weak. And so we really want to go out there and provide empirical evidence for strengths and weaknesses. Sometimes using this data can be a factor in determining a company's cash flow and its risk. Just doing a simple margin analysis. If you have a company that's doing a 60% margin, and the rest of the industry is doing a 75% margin, the ability for it to generate its cash flows is a lot stronger. And so that might make a difference in your discount rate or something along those lines. Discount rate or adjusting your multiple in a market method. The RMA data is one source of data that can describe a company and how it sits inside of its industry that it's working in. So let's talk a little bit about the Risk Management Association. Where does the Risk Management Association come from? Well, originally, let me start out by saying this. In 1910 to 1912, there was a recession in the United States. And because of that recession, some of the Sherman antitrust laws were happening at that time, and banks found themselves writing off a lot of business loans that could not be repaid in the trust breakups. And at that same time, they were creating the Federal Reserve System. And so there was a lot of this idea of let's revamp our banking system and let's be a little bit cooperative about it. And so in 1915, A group of bankers decided to mitigate their credit risk through the exchange of information. And what happened is that in 1915, 65 banks attended a meeting in Salt Lake City and became members of the Robert Morris Club. A year later, they had their first annual conference, and they later became Robert Morris Associates. Now, we're talking the same titles here, Risk Management Association, Robert Morris Associates. So let me talk a little bit about Robert Morris and why he was important. Back in 1776, I believe Robert Morris was the most powerful man after George Washington. And the reason is because he was the financier of the American Revolution. He was the guy that went to France, borrowed the money, put together our uniforms, put together our guns, put together the ability for us to fight the American Revolution. And he was a politician out of Philadelphia, Pennsylvania, and he was one of only 2 people that signed all 3 original documents of America: the Declaration of Independence, the Articles of Confederation, and the Constitution of the United States. He organized the First National Bank, the Bank of North America in Philadelphia. Now, the new system that he put in place for government contracting decreased inefficiency and waste in the system, and it contributed to the troops being fed and clothed. And one interesting fact I like about Robert Morris is that later in his life he was speculating in real estate in the Northeast, and he went bankrupt. And so he died relatively in poverty, but his contributions as the father of the credit system have had a long-reaching impact on the American financial system. And the key word here is American. Robert Morris was an American politician. So in the year 2000, they changed the name from Robert Morris Association to Risk Management Association. Now, they said, when I say they, the Risk Management Association inside of their press releases said they wanted to reflect new endeavors. So I interpret that to mean, look, they're trying to spread their wings a little bit here and do more international type information exchange, not just American information exchange. And Robert Morris might be offensive to some of those international countries, whereas risk management better reflects, their real purpose, and that is let's mitigate our credit risk. So today, well actually last year in 2015, RMA has approximately 2,500 institutional members that include banks of all sizes as well as non-bank financial institutions. And they are represented by 18,000 risk management professionals who are chapter members in financial centers throughout North America, Europe, and the Asia Pacific. RMA produces the annual statement studies every year. Financial ratio benchmarks derived directly from more than 250,000 statements of financial institution borrowers and prospects. And that's an important statement there. We'll get into that in a little bit. But those financial statements come directly to the RMA from the member institutions whose data is coming straight from the businesses they serve. So you have business loan officers who are reading these statements and are responsible for making sure there's no write-offs under their name. And they're looking at those statements and submitting them to the RMA, who then processes them, aggregates them, and puts them out in the risk or in the annual statement studies. And they've been doing this for over 75 years. So we're talking about a long history here of what's going on with the data. And they use that in their lending decisions. So for the 2015-16 data, there was 178,000 statements without percentage of completion. And I counted 755 industry or separate NAICS codes. Now that's not slices of data, that's NAICS codes. And I also counted 103,000 statements with less than $10 million in revenue. So what this tells me is that if we're looking for a source of data that represents the super micro businesses, and my definition of super micro businesses is probably less than $2 million, but certainly less than $10 million is definitely in the category that I could compare it to. So, I don't know of another source that has that kind of data inside of it. At this point, I think I need to ask my next polling question. So what primary sources of comparable data do you all use when you're looking at the data? And we're just going to take a little bit of a quick little poll here inside of the little webinar. And I'll leave this open for about 5 more seconds. 5, 4, 3, 2, 1. Let me close this and let me share the information with everyone. Looks like quite a few people are using RMA. A few people are using BizMiner. Integra or First Research is high on the list, and a few others are using other items and ProfitSense. So when we look at all of that information, the question I have is how do you vet your benchmarking data? You know, how do you make sure that you're credible? Vet means to subject to a deep and involved investigation, you know, an evaluation here. And then at the end of all of that, after you vet your information, the question is, you know, what reputation do you want to cultivate? So I think some of the questions that we need to ask ourselves are, where does the data come from? What's the process to obtain those numbers? Is the obvious transparency is important? Is there a bias in the numbers? And how granular is the data? What are the strengths and weaknesses, and how is the data relevant to the subject company? Relevancy is an important factor inside of our credibility and inside of our reports. But let's take a few of these different databases out there and spend a couple of minutes on them. I don't want to make the webinar about these other ones, but I think that when you contrast RMA data against these other ones, you might come up with an interesting juxtaposition. So another database that we put together is the IRS corporate ratios. Basically, the IRS corporate ratios would go out to the statistics of income from the IRS. We look at that, we compile the data, and we put together ratios calculated the same way as the RMA ratios, as a matter of fact. Now, the strength of that is that's a statistical analysis of all the Form 1120s that were put together in the United States. That's a pretty good representative sample, and you know that the statisticians putting those together, you know, are well qualified as well. The problem with it, the weakness with it, is that it comes about 3 years later. So it takes the statisticians about 3 years to put that information together and publish it. So you're really looking at something that might be 3 or 4 years old. Sometimes that's okay, sometimes that's not okay. BizMiner was another popular source out there. The reason I like BizMiner data is that it's relatively cheap. You know, for $75, $100, you can get a little piece of paper that says, here's what the industry benchmark should be. And if I'm only doing a few valuations in a year, that makes some sense to me. But you need to realize with the BizMiner data where they're obtaining that information from. The process is not transparent, and they have an economic model that they put together and try to show you what the past has been, or they try to predict what the past has been. And when you're using an economic model of the past instead of actual numbers of the past, you might miss something that's important. Integra Info has been out there for a while, and I remember talking to David when he was first trying to pump this information in the marketplace. It was in 2004, New York City, and you know, I asked him, I says, you know, where are you getting all this information? And they have, you know, 50 or 60. You can go to their website and find out how many different data sources they're pulling from. The IRS data is one of those sources, by the way, but they pull all that information together, run it through an economic model, and predict the past. Now, the strength of that is that when you're providing a mathematical model, you can calculate a number for everything. So they have all kinds of numbers inside of their data. The weakness of the data is that it's an economic model trying to predict what happened in the past, and as a result, you know, it may miss some items, and it gets updated and changed about 3 or 4 times a year. And so you have to be aware that when you make those changes, data can shift on you. So, you know, the percentage of cash on your balance sheet in 2001 might be different in the 4th quarter than it was in the 1st quarter. I'm not saying any of these are good. I'm not saying any of these databases are bad. I'm just saying to understand what the strengths and weaknesses of these are. ProfitSense is another, well, let me start with First Research. First Research pulls their information in from Integra Info. It's micro-built data, and so you're dealing with the same problems that strengths and problems that you had with the Integra data. ProfitSense is another interesting database aggregator. So what ProfitSense does, and that's PR, yeah, well, you saw the polling question, you know it's spelled with a C. So a compiler of financial data inputs the balance sheet and income statement, profit and loss statement into a database that's managed by SageWorks. And when you take that data and you put it inside of there, you'll get back information that says, look, here's what the industry has in your comparative group, and here's how you sit in that industry. And the cool thing about it is that they also tell you about, hey, this particular ratio is too low, and here might be some ideas you can do to improve it. And this particular item might be too high, and here's what you might need to do. And so it kind of gives you a little bit of an analysis, some artificial intelligence behind those numbers as to which direction to go. As a certified public accountant, I have to follow my ethics, and one of those ethical rules is confidentiality. I've talked to a person who was on the ethics committee, and it was made very clear to me that if you input information from a client into a database like that, even if you take off just the name of the company, that is not protecting confidential information. So what I would suggest is that if you use ProfitSense, make sure your engagement letter, you put in there specifically that you're going to put their information into a database that's aggregated like that, and that way there you stay out of trouble with your ethics. So let's talk about RMA data. So I've talked about these other ones here for a couple of minutes. Let's talk about the RMA data. What are some of the strengths and weaknesses of the RMA data? So RMA data is put together by banking institutions, and so you have to look at and say, look, these companies here are leveraged, or they're going to be leveraged. And usually when you try to apply for a loan, you think you have cash flow to service debt. Well, if you have cash flow to service debt, you're talking about the top tier of these companies that have been around for a while and can afford to get the debt from the company. And so you have to say, these are data for loans, and how does that affect my particular subject company? You also need to realize that there's only 257,000 statements, and so in some cases there may be limited samples, and the data collected in some circumstances may not allow them to present the information. So for instance, if there's only 3 or 4 companies in a slice of data, you won't be able to see what those companies are because it'll be too easy for some of the competitors to pull out information inside of there. Some of the definitions that the RMA data has are not as specific as we would want as valuation professionals, and so we have to look and say officers comp. Well, officers comp just says here's all the compensation paid to officers and directors. And so when you look at that particular ratio, you can't say, oh, this here is the amount paid to one person. That would be, in a super micro business, you're trying to say how much would an absentee owner have to pay this person to run the business. And I don't think you can get there from RMA data. You don't know if the items inside of the balance sheets are cash versus accrual. This is creating an apples to oranges comparison. If somebody's on an accrual basis versus cash basis, we might have a mismatch of timing, and so we have to be careful of that. A lot of times in the RMA data, you have to make the assumption that people in the same slice of data will be accounting for information basically the same. Public versus private information. We don't know specifically if there's a public company, but if you read the FAQs out on RMA, and when I say that, you go to RMA- it's either rmahq.org or rma-hq.org, and you can look up the products and look up the annual statement studies and read the frequently asked questions, and you can read about the RMA data. That's where a lot of the information has come from. But it says that most of the statements are coming from private companies. The same goes for international versus U.S. only companies. It says most of these companies are U.S. only, and typically there might be somebody who is an international company but has an American branch, or they're doing business in America, and that's how that came to be. Some other issues are how granular is the data. While there's a lot of granularity on the slices and the size of the company, there's not much in some of the other things. Operating expenses are not broken down, for instance. And so if you want to find out what rent is or depreciation is, you cannot see that inside of the RMA data. You're saying, great, Dave, like a good accountant, you're going to tell me all the bad things first. Well, what about some of the great things? What are some of the good things about RMA data? What I like most about the RMA data is that these are real companies with real financial statements. And while we may not be able to say these are completely comparable, I think that over a sampling size, you can start to do that. And the data is not a model of the past. And I have real problems with models. That's a personal opinion. Like I say, a lot of people don't have problems with the models of the past, but it's not a model. This is actual numbers, and so you can get historical basis and say, here's what was happening in the industry at that point in time, and you can see that. It's a transparent collection process. In other words, I know exactly how the numbers are being generated. They're not close enough these are the numbers, and you can tell exactly. I put the intro out there in the handbook, the intro of the annual statement studies book out on the handouts bar over there, and it tells you exactly how they calculate it. They say we bring in the statements, and this is exactly how we calculate those pieces of data that we're looking at. We also have a history here of quality data. Now, all of those data sources that I've talked about, I would say have a history of the quality of data, so this is not a standout from the rest of those, but there is a history of the quality of data. And the valuation edition has granularity not seen in any other data. And that's supposed to be a teaser for what's coming up next. Why is the valuation edition so good and great? But let's go back and talk specifically about the primary data that comes inside of RMA. If you've been in the business at all for valuation, you have some idea there's a common size balance sheet, a common size profit and loss statements. Value Source will extend those to show dollars. If you get the book by itself, there's an average assets and average revenue down at the bottom of the page, and you can look at those and extend those yourself. But Value Source does it automatically for you. There's 19 common ratios, and inside of those common ratios breaks it out into high, median, and low. We'll talk about what that high, median, and low looks like here in a minute. There are some of these that are nonlinear, and that's an important piece. So nonlinear means that it's going to go from the lowest positive to the highest positive, followed by the highest negative to the lowest negative. It is not true ascending or true descending order for a particular ratio. And those three that are delineated here on the slide deck, sales to working capital, fixed worth to net worth, are involved in that. The reason that they're doing that is because they're trying to pick that inner quartile. An inner quartile is take somewhere around the median or the average, take 25% on top, 25% on the bottom. So about half of the companies are operating in that inner quartile range. And by nonlinear order, they can say, here's where half of the companies are operating, and say that this here is, what a good number would be for those particular things. So obviously, if you're below the lowest or you're above the highest, and this is where the high, median, and low come into play, the high is the 25th percentile, the lowest 75th percentile. I might have those backwards depending on the particular element you're talking about. But that inner quartile gives you, here's where most of the businesses are transacting at, and you can say that if I'm inside of those, then I probably have good cash flows and I'll repay this loan. That's what RMA is trying to do with that particular logic, and that's why those items are nonlinear. If they did it a linear way, the companies in the middle would not be representative of what a good inner quartile would be. RMA data shows us data slices, and the M inside of the data stands for 3 zeros. It's a Roman numeral, stands for 3 zeros. They're banking institutions, and so that's the vernacular that they've picked up. I don't know, when I used to trade bonds inside of the financial institutions, the confirmation slips would always have an M on them. I do know that other data sets, sometimes will use a small m, or an M stands for million, but in our case, the M stands for 3 zeros. You can see the slices of assets that are appropriate there. So you got your 6 categories, and this is what gives you some of the granularity of RMA data. And you can pick your subject company and say, how big am I based off of assets or based off of sales? Now the historical piece, and I'll show you an example here in a minute of how the book is laid out, and it'll give you an idea. But the historical are all of the companies. So in the asset size, if you had 114 companies in assets, you'd also have 114 companies in sales. Now they might not all have categories listed under here, but you would have 114 companies. The historical has all 114 companies in it, and that will go back for 5 years. So you're looking at the industry as a whole, and it goes back for 5 years, and all of the companies that were collected for a particular year are represented inside of there. And that's the difference between the historical and the different slices of data. Interesting point, you have to be careful about mixing and matching data. So if you're looking at a slice out here, of the 100 million and above in assets, and then you go over to historical and you say the officer's comp to revenue was a particular number, you know, you kind of jumped gears here and you said, look, you know, this is the size of company I'm looking at, but the historical number is also going to have the 0 to 500 and the 500 to 2 million. And so that number may not be representative of the industry. So you have to be careful about which slices you're looking at. And when we do a multi-year analysis, what we do is that we take a particular slice of data and we just go back 5 years for that slice. And that's an important piece because some people think that 5-year historical in the middle would give them the same kind of information. So make sure you understand what those different search features are inside of the data that gives you where you want to be at. I want to talk about the regions. The RMA data can be broken out in regions if you purchase it from RMA directly. Our Valuation edition has those same regions: Northeast, Southeast, Central, North Central, South Central, and West. My example I use there is that if you were looking at the textile industry in the early 2000s, down in the Southeast, all of those textile mills and all of the cotton places were shipping their labor out. They're going to the Dominican Republic, going over to Haiti, going down to Mexico. The textile industry in the North, in the Northwest, did not ship its textile industry over to the Pac Rim. They continued to operate there. So by breaking it out by regions, you can tell, look, if I'm operating down in the Southeast, I have this information. And you know, interestingly enough, not all of the textiles got shipped out. I was talking to somebody who was doing pillows, and actually bedding in pillows, you don't want to have those pillows inside of a shipping crate and crushed down because the fill fiber gets crushed and the pillow isn't worth anything by the time it gets shipped back to America. So the pillows in the Southeast worked out pretty well. They stayed there. Anyway, I digress a little bit here, but it's fun to hear some of those little details. I think it's important to realize what dates we're talking about in a particular book. So between April 1st and March 31st of the current year, for 12-month periods ending during that time. So if somebody had a June 30th financial statement end date, and they would pick up the financial statements in that period. If somebody had a December 31st, 2015 date, it would be in the 2015-2016 book. And the reason they go out to March 31st out here is because they want to pick up that year end of data. So in the 2015-16 book, I think I said it wrong. You would have December 31st of 2014. We have the news data. I believe it's going to come out November 1st. It'll be the 2016-17 edition. So statements end March 31st of 2016. That means that December 31st of 2015 are included in that data. And so when you're using year-end stuff, you know, that would be the most important piece to look at. And it's important when you're trying to compare up things. A lot of times I see people saying, well, it says 2016-17 on the book, so I'm going to compare it to December 31st of 2015, and that would probably be appropriate. If you don't have that book yet and you're doing December 31st of 2015 and it's back in April and you're trying to pick the 2015-16 edition, you probably can't compare it to that last period. It wouldn't be, you know, exactly apples to apples. Here again, read the intro to the book and you can see all of that. So this is what I was trying to tell you. This is how the book is laid out, and I think if you look at the book. So the spine of the book, give me a second here. I need to collapse this a little bit. Let me grab up my little marking pen. So the spine of the book is over on this area here. And we'll look at the page on the right-hand side in a second. But to the far left of the spine, you get the asset size. In the middle of the spine, you get the historical data. And in the middle of the page is where you list out all the ratios. Now this here is for cash flow measures, and it's a sample they give. I couldn't really pull out a sample of the annual statement studies, but it's laid out the same way. So instead of cash flow measures, you're going to see here's the common size balance sheet. Here's the common size P&L. Here's your ratios, quick ratio, debt ratio, sales to net worth. And those will all be listed in the middle of the book here. These are the types of statements that are available, and as I said before, you know, which ones are comparable, which ones aren't comparable. You have to take a look at that. If you add up all of these numbers here, you come up to how many statements are available in the system, and when I get over on the other page, I'll show you what that looks like. You can see what the dates of the data is, and then if you go down a particular column, that data will exist. There's only 2 statements in this column. They're not going to show the data. There's 7 statements in this column. They're not going to show the data. So that's part of the weakness that you get to see. Let me erase these and go to the next slide. And this is the other half of the page. So in this case here, the spine of the book is over on this side. And so, you know, think about it. If I open up the book to 2 pages, we saw the left-hand side, this here's the right-hand side. And so if I look at all of these particular values of data on the sales slice, I'm sorry, this here's the sales and this here's the historical, those will all add up to 43. And you'll see that in your historical data, you know, you probably have a better idea and numbers will exist because they don't exist for these areas in here, but you're looking at the whole industry. And so you need to take a look at that. Also, some of the numbers that we have out here, and they're listed in our database. You can see them. There's like the number of companies that are being represented. Make sure that that matches. So in this case here, there's only 10 companies reporting for changes in inventory, whereas there's 12 companies in the sample. And that'll give you an idea of what's going on there. But that's how the book is laid out, and sometimes understanding that makes it a little easier when you get into the database and you're trying to select what slice of data I want to get to for sizing. So what's so special about the Valuation Edition? Well, what we did was we went to the Risk Management Association and we said, hey, as you're aggregating these statements, would you do another calculation for us? Would you put this algorithm on it and give us the extra data? And that algorithm is a few slides down. It's transparent. You know exactly how we calculated this algorithm. What that algorithm does is that it takes the data that's arrayed in linear order, true order, from lowest to highest, and it cuts it into 10 pieces. And as it cuts it into 10 pieces, we get 10 percentile, 20th percentile, 30th percentile. Well, having those intermediate pieces inside of the data allows for a better analysis of the subject company, and it provides evidence for a stronger report. So let me show you exactly what that sounds like. Which sounds better to you? So I'm over here. If you're using the standard database, you say something like this. The average operating expense of this company is 85%. The average industry is 85% as well. This means the company is near average and the value of the company should be near average and no adjustment will be made to the discount rate or to the multiple. It's an average company. Or we can say this one over here with the p-tile information. The 38th percentile means 38% of the companies have a lower ratio and 62% have a higher ratio. This company is at the 38th percentile, and so this means that this company, or since operating expenses should be low, this company is better off in the industry. And the value of this company should be higher because the discount, and therefore the discount rate should be reduced. And we're doing that based off of this idea of the percentile. We can go in and calculate how many percentile in an industry it is. So what's the difference between the average and the percentile piece here? And we're going to take a look at that here in a second. But I think you get a better credibility piece if you can say, look, 38% of these companies have a lower ratio. If we're talking about operating expenses and only 38% have a lower ratio, I'm higher than 60% of these other companies out there. I am stronger in the industry. I am not just average. I'm not the 50th percentile. I'm not the median of this grouping. That's what we get to say. That's what we get to do. So now I have to go back and I have to wrap around all of this and show you how that happens. In the standard edition, what they do is they take a particular element. Here's gross margin. Here is the quick ratio. Here is the sales to net worth. Here's working capital to net worth. All of those. And they array those from the lowest to the highest is what they do. Then what they calculate is they calculate 75th percentile and the 25th percentile. The median is 50%. So this is going to be high, this is going to be low, and this is going to be the median. And as I said, what they're trying to do is they're trying to say 50% of the businesses operate in this middle category. So if I'm a loan officer, I can go out there and say, in that middle category, this is where I operate at. If you do it in a percentile range, what it does is it calculates this 10, 20, 30, 40, 50, 60 inside of here, and the percentile says I am this many below and this many above. Take it outside of the valuation industry. The kids are in college and they're taking all these standardized tests. And it says you are in the 92nd percentile. 92% of the kids taking the test on that day had a lower rate than you. Only 8% of the kids taking the test that day had a higher value than you. And that's what that percentile does for you, and it kind of helps lay into a population of what's going on. Now, how do we get specific from the 10th and the 20th? So we get specific and we say we can get to the 38th percentile. In this case here, I'm using the example of 27. It's linear interpolation. You can go out to the internet, type in linear interpolation, and they will give you the formulas on how it does. So basically it takes the ratio from the number here and the number here, and it takes and says the base of that is 10 p-tiles. And so if we have a number here and we know that the base is here, we can just use a simple cross multiplication problem to figure out the answer is 27. And so it's basically taking the ratio to the percentile and the difference between the numbers in there, and it gets you to where you want to be. The linear interpolation allows us to pick a specific p-tile range. So ValueSource has an algorithm that gives you the 10, 20, 30, 40, 50, 60, and then you can use linear interpolation. Here's the subject company number, and here's what the numbers are and the percentiles, and you can use linear interpolation to get down lower. This is the algorithm that's used that we give over to RMA, and we say, here, perform this algorithm on every single element that's out there, and they do that. We put it inside of the database. So here's what's going on mathematically. You have an arithmetic mean. So that takes all of the items and it divides it by the number of items inside of there. That's what the average is. The reason that RMA uses averages for their common size balance sheet, common size profit and loss is because averages will equal each other. So if you take the average profit before taxes, it will match out to the average percentage. If you take the 75th percentile of profit before losses, it will not add up to what the company has. And so that's the reason why they're using averages on the profit and loss. And then they have medians for the ratios. And so the median is the middle number, half or above and half or below. And the problem is that there's a skewing between the two. So here's the example. If we take, and this is outside of valuation, if we take everybody in the webinar and we say, let's add up all of your charitable contributions off of your tax returns, and we calculate an average charitable contribution. And now all of a sudden Bill Gates or Warren Buffett walks into the webinar. Their charitable contributions dwarf ours. And as a result, the average is going to get skewed way high. And so we have a problem here when we're looking at the benchmarking in the samples and saying, okay, if we're just taking averages and there's a wide difference between the average and the median, or between the median and or between a percentile and the average, you can see that skewing and how it takes place. And so you have to ask yourself, you know what I mean, are the sample populations represented and described by the good averages? So let me come back to the example we talked about in our credibility issue. Here's the average column, and here's the 10, 20, 30, 40, 50, 60, 70, 80, 90th. You only get these percentiles inside of the valuation edition from ValueSource. So the operating expenses is 85%. That's average. So if your subject company was 85%, you would say, look, I'm average. But look what happens over here. The median number is 91%. And if you have a median of 91% and an average of 85%, you know, 6% of your dollars, that's a difference in operating expenses. What does that mean to the company? We look over here and we say between 30 and 40, you know, between 78 and 86, the company's average was 85%. We're probably looking at the 38th percentile. And that's how we do the linear interpolations. We say companies 85 to 78, the data is from 86 to 78, we can figure out what the ratio is and calculate it. And we come up with 38th percentile. That's what the difference is that you get to see how this curve is laid out. Now, that said, you have to be careful of a few things here, okay? And I want to make sure it's very clear that we're careful of a few things. Let me hide my little bar over here. The first is you have to look at your population. There's 263 statements inside of here. These make sense. Let's say there was 12 statements inside of here. If you cut up 12 statements into 10 pieces, are you really getting any granularity or not? So you're going to have to use your professional judgment and say, does this make sense for the population I'm looking at? The other thing you have to look at is you want high profit before taxes. A company with a higher profit before tax is going to be worth more. You want this to be in the high numbers. But operating expenses, you want to be low. You want to be in the low numbers. So don't think of the 10, 20, 30, 40, 50, 60, 70, 80, 90 as grades. You need to think of them as saying, do I want to be low on this scale or do I want to be high on this scale? And compare it to that. So each element is lined up for its own particular analysis. And because it's element by element, we don't get to choose, oh, this company is in the 75th percentile. Wouldn't that be awesome if we could go out there and say, look, we're going to put you in our little algorithm and your particular company is in the 75th percentile, which means it deserves a higher price. Doesn't work that way. That's what you get to do as the expert and create all of those values for yourself. That's what we do. That's what's special about the valuation edition is that you get these p-tiles and you can lay that out inside of a report and say, look, here's how many people are below me, here's how many people in the industry I compared myself are above me, and therefore I'm stronger or weaker in the marketplace. Real quick here, about 4 or 5 minutes away from ending. This is how you go out there, you go to VE Data World, you log into RMA Valuation Edition, you get to select what data that you're looking at. Some people will want a one-year analysis, some people will want a multi-year analysis. Remember, our multi-year analysis takes a slice of data and compares you against that slice for each of the years. So if somebody changes slices in the middle of the years, you're going to have to take that into consideration when you do your report. My personal opinion is that most of the time I like to do a one-year analysis. I do a multi-year analysis only when I'm trying to figure out what the trend of the industry is and say that the subject company's trend is different. Now you can decide if you want to apply that before or after you do a ratio analysis, and that's a decision you get to make, is how much time do I put into a specific area before it's too much. This little V out here tells me that it's the valuation edition. This is the year that I'm starting to look at. I can select my NAICS code either from a list or a search. If I was operating the system in front of you, I would choose from search, type in the word certified, and we get certified public accountant to come up down here. If you're doing a multi-year analysis and there are several NAICS codes, you know how the NAICS codes changed in 2002 and 2007, I believe. If there's something that you need to compare to, they don't match up quite right, you'll get a slider bar down here on the bottom that says which one do you want to compare it to. And here's where those categories are. So sort by assets, sales, or historical is this first box. Here's the region. National is what comes in the standard edition, but if you want to break it down to Southeast, you get there. And here's your data slice. So based off of assets, 0 to 500 million, that's what shows up in the box down here. And then in the working pane, we break that out. I think if I go to the next tab, give me a second here. Sometimes I get ahead of myself on this. So we talked about how you select those pieces. Here's what I wanted to get to. In the working pane, so this is number 2, you get to see the data that shows up over here. And you can choose an income statement or balance sheet or the ratios, and you get some idea of what's going on. But we break this out and we extend this. So if you look at now this is the sales category, 1 to 3 million, but I realized that if you pick an asset category, you get to see the average sales of that category. And so you get about, 5 or 6 more different categories of sales that you can compare yourself to and say, look, the average sales of this particular group was this, so it's 1.8 million, maybe I'm closer to that particular revenue mark than I am the revenue marks that they have in their sales slices. But you get to see the extension of the data. That's where I was really trying to head to with that particular analysis. Next schedule down is we have compound annual growth. Now, based off of the historical numbers, we can go to a particular area and we can say, okay, the base year was 2008, and we can calculate compound annual growth based off of the average net sales for each of those categories. And we can do that off of the average thing. Now you need to realize that the population of companies inside of each one of those years changes. So we have the same arithmetic average problem we had before, and that is that you could have a really great company, great profitability in a particular company in year 2012, and that's not in year 2009. So these compound annual growths are going to be a little bit skewed. I wouldn't necessarily hang my hat on these numbers, but what I can do is I can get a feel for how the industry is tracking. And sometimes it's very difficult to get an idea of what an industry is doing, how it's growing, and having several different sources can help you understand that a little easier, a little better. So be careful with the compound annual growth. It does exist because we can take each element and use the compound annual growth formula, the arithmetic, to calculate it, but understand where those numbers are coming from underneath, and don't necessarily hang your hat on that particular piece of data. But it does exist. What is it I hear somebody say out there? They says, you know, usually we have no data. Sometimes we have some data, but it's not very good data, and other times we have really good data. And this here kind of falls into that second category. Same sort of deal here for income statements. This here is the multi-year analysis. And what I want to get to next is step 3 down at the bottom is that there are Excel sheets that you can export. So typically when you choose the data, you're getting a spreadsheet without any macros, and you are able to look at the data that was in the working pane and have that pull forward. That's a nice little piece of information. So where did you get your information? I choose that data only. Here was the data that I got off of the internet on such and such a day at such and such a website, and this is specifically what it was. The analysis piece does that P-tile information for you. So we go out there and we say type in the subject company balance sheets, type in the subject company P&Ls, you know, and it's that abbreviated statement that this RMA has in it, and then it will calculate the decile information for you. It'll calculate and say, here I'm in the 38th percentile for this particular piece. The software will also download this information and calculate it as well. And that's what this is supposed to represent. So let me scooch this over a little. And at the end of the day, I'm back to the whole credibility issue. How do you want to present empirical information inside of your reports? The subject company was 7.81%, RMA was at 2%, so I'm very high above the average, therefore I deserve a stronger piece. Or do I want to say I was in the 83rd percentile, which means 83% of the companies I compared myself against had a worse profit margin or a worse pre-tax profit than I did. And that means that only 17% had a better pre-tax margin than I did. Therefore, I should command a higher price, and you can take a look at that. Software has the P-tile information automatically. This downloads automatically into the software as well. So 2 ways to access the data. I think do that. I want to thank you for attending today's webinar. RMA is one of my favorite webinars. There's a lot of information here that's going on. I think sometimes we spend more time in our thought processes of how to discount cash flows as opposed to our thought processes of saying, hey, is this company strong or weak in the marketplace? What are its strengths and opportunities? And how do we view the subject company itself? And we're actually using information that we have very, very high reliability in. This is the subject company information that we're calculating these ratios off of. So anyway, thank you for attending today. I hope you got something out of it. Feel free to reach out to me. And thank you. I am going to leave this up for a couple minutes, but I am going to sign off from talking anymore. Have a great afternoon.